morning, everyone. Graeme here, as always, each week with Dr. Andrew Wilson, Chief Economist of My Housing Market. Good morning, Doc.
Yeah, good day, Graeme. Once again, another, I guess, exciting week for news. Not so much in Australia, but certainly overseas is taking the headlines. Talk of bank failures. The financial sector had to get bailed out. Well, one of the banks in the financial sector had to get bailed out last week by the big boys and girls because there was a run on the bank. And, is it a rerun of 2008? Well, not sure that it's as bad as that, but certainly we shouldn't be surprised with higher interest rates and a lot of risky behaviour happening, particularly in the IT sector, that we're getting a few issues with some banks at the moment. And, the question is, how far will this run? And, it doesn't have a lot of implications for Australia because, thankfully, we have a much more rigid banking sector here. We've certainly only got 4 banks, not a myriad of banks as it seems to be in the US. And, we're very tightly managed for risk, as we do discuss from time to time, Graeme, in this country. But, of course, can be a bit of a firestorm once sentiment is affected, particularly on the stock market if we see this continuing in the US. But certainly it's a bit of a wait and see at the moment, Graeme. But there's no doubt that there are some perhaps smaller banks that are a little nervous at the moment, and nervous because their depositors are a little nervous and thinking maybe we should take our money out.
And Doc, it's a good point you made there that it is a particular type of bank. Yes, it's considered large by size and volume in America, but it specifically, or it's specialised in fintech or tech startups. Yeah. Silicon Valley Bank, right? So you've got to think too, when you've got entities with valuations at multipliers of 24, 28, 30 times, and some of these entities just professionally raise money every 90 days. Obviously, Australian banks or stereotypical banks anyway, usually focus on deposits, residential lending, business bank. They're fairly well diversified in comparison to this institution.
Yeah, and we've seen, Graeme, not just this week with the Silicon Valley Bank, but we've seen a softening in the tech sector over the last 6 months or so. That's been one part of the market that has been weakening. And I suppose we just sort of draw the string along and here we go. All of a sudden, one of the banks that concentrates on that tech sector finds itself in trouble. But it's not just the banks that lend to this particular market segment that have found themselves under some pressure. But there's also venture capitalists and investment funds that have also been struggling as a result of a downturn in the tech sector. Investors are not getting the returns that they've had before. And some of the really big investment funds that focus on IT and tech have really found themselves in some strife. Perhaps that's the wrong word, but certainly under some pressure because of the issues in the tech sector generally. And, we're also talking crypto here. Crypto has, caused a lot of grief over the last 6 months or so. Perhaps no surprise there, given the nature of cryptocurrencies. But that's also part of the story, Graeme. It's been a weakening of crypto. It's a very strong economy. The appetite for risk is very strong. The American banking system and financial sector is much more market orientated than we are here. And that's the difference. The smaller banks don't have the same get out of jail type of financial regulation as the large banks do have in America. But having said that, the Fed and the US Treasury have stepped into the Silicon Valley Bank and have guaranteed depositors. So the depositors will get their deposits refunded, I believe. But that's not going to save that bank. That bank's, more or less had it now.
And they all the ladies running the bank got their bonuses the day before it went under as well. I read, if that's true, so that's interesting.
Yeah, and there was some shares.
I don't know how you get a bonus on failure. I don't know how you gauge that as a metric, but
Well, as I said, I think there was also some share selling happening prior to the event as well, Graeme. So, those in the know were sniffing the wind perhaps, but, this is the US for you in a sense that it is much more market orientated. There is certainly a lot more flexibility in their lending environments. And one of the other issues, Graeme, was that this bank actually was concerned about its asset base, and it had purchased a large value of Treasury bonds. And that was, I guess, prudent thinking that buying government bonds. But the problem was that it bought the bonds when their interest rates were very, very low a couple of years ago. Of course, central banks were busily selling bonds to inflate the economy during COVID. Bit different to now, of course, where it's we're trying to deflate the economy. But I guess that's the hangover after the party, if you know what I mean. And this is part of that hangover, is that the bonds that Silicon Valley bought as part of their asset base, which is prudential thinking, are virtually sort of worthless now, because the interest rates on those bonds that they bought were, very low, whereas bond interest rates now are much higher. So, of course, that means there's not a big market to buy those low yielding bonds that the Silicon Valley Bank has, and they tried to sell them to cover the run on the bank, to cover depositors wanting to get their money out, but they couldn't find buyers. In fact, I think they were selling at a 50% plus discount to what what they'd actually paid for those bonds. And this is just a product of what's happened in our economy. You can't sort of blame them for wanting to secure their depositors their deposits with Treasury bonds. It's just that, those Treasury bonds were, close to zero, just above zero in terms of their returns, whereas we get a much higher return now. So obviously there's not a lot of demand for bonds with a low, with a low return, given that the current bonds, have a high return. So it's all part of that sort of process. And I think the other thing with the Silicon Valley Bank, Graeme, it also was very much focused on climate change, I guess, environment in terms of investment and startups, that they were the go-to bank if you had a proposition regarding climate change. And given the US has just passed, or has a very big policy that the Biden government has passed, supporting initiatives in climate change, in the offset to carbon, the carbon environment, that a lot of startups wanted to take advantage of that. There's a lot of support now, government support for to offset that carbon economy. So startups were wanting to take advantage of that, and Silicon Bank was full of propositions from those startups to take advantage of the the focus of the Biden government on that in their latest initiatives. So it's sort of probably to some degree, as these things are in hindsight, a little predictable, going forward. The question is whether depositors will remain confident in those other smaller banks. You've got to remember, this is really only the smaller banks that are seemingly exposed in the US. Their big banks are covered, basically covered. Their depositors are covered as ours are, but the smaller banks are. In fact, I think there's a cap on $250,000 in terms of the insurance schemes for those smaller banks. So you're okay if you've got your deposits are up to $250,000, but above that, you're in a bit of trouble. And but they have.
I don't know if anyone want to sit on more than. I don't know if anyone wants to be sitting on more than $250,000 cash at the current rate of inflation, Doc. That might be a little bit eccentric.
And that's also part of the issue, Graeme, is that, we have high interest rates, but we have higher inflation. So there's an appetite for looking at higher returns. And of course, higher returns always means, higher risks having to take on board. And when you've got the government as basically a partner, when you're looking at the climate change propositions and the government, support for that in the US, obviously it's a good opportunity, you would believe. But as I said, the tech sector has been under pressure now for the past 6 months or so. So this hasn't just come out of left field, Graeme. It's not just an irrational run on a bank. There is some backing for a weakening sector of that tech market, and that has been affecting other parts of the financial support for the tech sector, such as some of those big investment funds that focus on startups, that they've been having some trouble matching their returns. So, again, it's just a weakening of what's been, a very strong part of the market, the tech startup.
That's for sure. Well, Doc, let's have a look. How's it affected us here at home? Has it affected us at all this week? Any movement in the market? How's the next?
Well, I've got a slide here, Graeme. Maybe we'll run. I've got a slide in terms of the big picture. So I'll put the slide up now. Maybe we can talk to that. Yeah, with our usual, I guess, run of data for the week. We'll begin, as we've discussed in some detail over the past few minutes, Graeme, that US inflation is still high and the economy is strong. One of the issues that we have with this banking sector shudder, as I've called it, is that the Fed in the US are due to meet next week, Graeme, to decide what it's going to do with interest rates. Now, the interest rate story has been a little mixed going forward in the US. We've seen that inflation, although it eased slightly over February, is still quite high. The trend is certainly down in US inflation, Graeme, but it still remains, at levels that are too high for the comfort of the Fed. And there was an expectation that they may even increase rates by 0.5% back to 0.5%, which they had been increasing until the last couple of months, which they tracked back to 0.25%, because they don't seem to be getting inflation under control. But the problem, Graeme, now is that there's speculation that they won't increase rates at all, because it's going to make the banking sector, or put the banking sector under even more risk, as you could imagine, with higher interest rates. So there's a bit of a 50-50 bet at the moment for next week's movement in the Fed, whether they will actually go 0.25% or maybe actually put rates on hold. Now, this may be something that the RBA may take up if the US actually decide to hold rates, because they're concerned at the impact that may have on the banking sector, and we may follow suit, with our next meeting. But the big picture is, it is a confidence thing, particularly for share markets, which have weakened slightly over the last day or so, Graeme, which will, of course, find its way to Australian share markets. They will typically follow the US market downwards if it does fall. So there's some implications there. But as far as our banking sector is concerned, we have a completely different environment here. We only have 4 banks, basically. And as through the GFC, when there were some issues regarding concerns about a run on the banks back in the bad old days of the GFC, the government did step in at that time, and we basically have all our deposits in our banks are guaranteed now. So there's no real concern for Australian depositors for the sanctity of their deposits. And again, this just reinforces the strengths of our banking sector, which obviously works without a lot of competition, because there's only 4 banks. But in comparison to the US, where there's a lot of competition in the smaller bank sector, and that means, of course, when you have higher levels of competition, you need to take on more risk, and that's what's happened with those banks, those smaller banks, which are particularly focused on risky markets, such as the tech sector, and what's proving to be perhaps a little risky too is the climate change, the carbon transference sector as well. But the big picture is Australia doesn't really, other than perhaps the share market, doesn't have any banking sector implications at this stage, because we have a completely different market environment.
Unless you're a finfluencer, Doc, then you're going mad on TikTok and Instagram now that banks are failing and run and get your money out and blah, 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 blah.
But it's the old story, Graeme. It's buyer beware, isn't it? Caveat emptor in terms of taking on higher risk.
Yeah.
And again, we continue without trying to sound, they would say that, wouldn't they? Doesn't it make the housing market look even more resilient in terms of these, in terms of optional choices, investment choices, and this is the point, I guess, that people are looking for higher returns in a high inflation environment. Real wages are falling, so perhaps they're looking for options. But at the end of the day, bricks and mortar continue to prove to be, at the standard in terms of medium to long term investment credibility. And this is just another indication of where higher risk investments can lead you. Certainly in what are difficult economic terms with higher rates chasing higher inflation at the moment.
That's for sure. Okay, well, a bit of movement. Let's see how that plays out globally and internationally. But I think you're right, Doc. It's not really going to do too much to us here on Australian shores.
Well, not in the banking sector, Graeme. But look, at the end of the day, I'm not saying this is a rerun of the GFC, because a lot of things have changed and the banking sector tightened up after what happened through the GFC. But it's like a wave effect, that it can impact the broader economic performance if we see issues such as this that occurred in the US spreading, and that can have implications for our economy going forward. But as I said, I think the real short-term interest will be what the US does with its interest rates next week. Will it raise them again? Will it think, no, we just got to be a little careful at the moment, we'll put them on hold? The inflation data really doesn't support any argument for not increasing interest rates again. In fact, I would have thought that it was, the argument in favour of a 0.5% increase was stronger than the 0.25% in the US, even though inflation has eased slightly. We're still seeing a very, very strong economy in the US. The latest job numbers were really strong again, Graeme. The market's been trying to talk it down and say, it's going to start falling, jobs growth in the US, but it hasn't. It's stood up, and it's still well ahead of what forecasters predict on a month-by-month basis. So people are still, got work, low unemployment rates, wages are rising still quite strongly. So there's no sign that higher interest rates have affected the American economy, Graeme, as the regulators, as the Fed was expecting it to. And that can only mean that rates should go higher, will have to go higher to try to control inflation. And, as I said, the argument will be we're similarly here where, we haven't really made any headway similarly against inflation with our higher interest rates. And we await with bated breath the latest unemployment numbers to come out, Graeme, which will be coming out imminently for February, to see whether there is even some more signs that, that the economy is starting to at least feel some impact from those higher interest rates.
Well, we've touched on this before, Doc, but I can tell you on the Gold Coast, when I'm at home there and I go for a jog, the mall is full, and everybody, I hear these little comments, you guys stay here and get ice cream, and I've got to run back to the hotel and do my Zoom. If we stopped people working remotely, they wouldn't be on the Gold Coast on the beach pretending to work. So, and foreign language, Doc, go for a jog along the beach there, and I'm hearing more foreigners chit-chatting walking along the beach than ever before. So our economy's booming because everybody's out spending money and everyone's traveling. And, a lot of people are working from home, but they're actually traveling and holidaying while they're pretending to work.
And this is the benefit of
this
is the benefit of a recreational market such as the Gold Coast, Graeme, that with a fluid hybrid type of workforce, you can have the best of both worlds. You can have, you can work in a recreational environment, and that's part of the reason, surely, why we've seen such a strong and continuing strong Gold Coast market, particularly in the rental markets. That's part of that, combination of living in a recreational environment, a recreational market such as the Gold Coast, and, still being able to work. So, but it will be interesting to see, how things pan out. Confidence is always very important in the banking sector, Graeme. So, over the next week or so, we'll see whether, confidence can be restored through the actions the US has taken, the government has taken, while the financial regulators have taken to offset, any chance of a run on some of those smaller banks. But, this is the price that inflation, this is similar. The circumstances now, Graeme, and I'm not saying it's the same, but circumstances are similar in the broader economy as they were in the lead up to the GFC, with inflation rising, low unemployment, and higher interest rates, and those areas which were high risk areas in the US, which at that stage was the housing market, but that was all about, the risk there was about the clever people having created all those clever little financial mechanisms to take advantage of strong housing markets and be caught with their pants down. Yeah, well, they were caught with their pants down when, the music stopped and they didn't have a chair to sit on. So,
or pants to pull up either.
That's right. So, as I said, it's different now because regulators have ensured that won't be repeated. But it's still a question of taking on higher risk and, the consequences that you do pay, you can pay for taking on risk. And this risk isn't so much the housing market at the beginning stages anyway. In the US, it's about the tech sector and carbon, climate change startups.
So let's ignore the climate change and the tech spec or the spec tech banking, Doc. What's happening in Australia's housing market right now?
Well, it's been a very interesting week, Graeme. We always say that, I know. I thought we discuss here about the mismatch between supply and demand in Australian housing markets, that eventually that has to catch up in terms of higher rents and higher prices, regardless of where interest rates are going, particularly given we have this unprecedented surge in migration coming into Australia with borders now open, very strong appetite to recommence international migration. And as we often discuss here, there are a lot of stories about the waiting list now, how long it is if you want to get a permanent residency in Australia. We're limited to 200,000 a year, but there's a lot more than that are in the queue to try to get in. And also now we're seeing the temporary visas from students, a rush for temporary visas from international students, are also pushing demand up. China has said, yep, get out there, get yourself a course somewhere. Australia is a preferred destination. We have strong cultural ties to China, of course. And now the universities and the tech colleges are all saying, hey, we want face-to-face here. Let's move away from the hybrid or the online models. Let's go with face-to-face. So we're going to see and are seeing now a surge in students coming in. The problem is we just haven't been building houses over the last 4 or 5 years, Graeme. We've fallen away except for that blip that we had during Home Builder in early 2021. The numbers continue to fall. And the real problem is that, we've now got another joker in the pack, and that is high building costs. And they're not showing any signs of coming back either. So even if you can get your permit approved and you can get a building approval out there as a developer, then it's more difficult to get that job out of the ground because of high building costs are questioning the profitability. So I think even those lower numbers of approvals have less of a chance of becoming actual jobs, of getting.
And this is an interesting one, Doc, because I see some of the comments on the YouTubes and some of the snippets we put on social media and all this sort of jazz. And there's a lot of people that whinge and whine and make excuses. But I mean, if you're a family with 4 or 5 children and you want to live in Sydney CBD or surrounds to earn Sydney money, you may find it whether it's a rent or a mortgage, it's not feasible for everyone to want to earn Sydney money and live in Sydney, or Melbourne money and live in Melbourne. Some of them may have to live in a different area and adjust their lifestyle.
That's right, Graeme, and that's the problem. You go to Sydney to live, you pay a lot more for a house, and you probably pay a lot more for everything there. That's the price for those higher wages. Now, Sydney has the strongest economy in the country, strongest capital city economy with the lowest unemployment rate. It's really chugging along. Of course, as we'll see quite so soon, prices are now starting to rise again in Sydney. Shock horror for a lot that predicted, a long-term collapse in prices. Well, Sydney prices are on the up again at this stage. So strongest economy, strongest housing market. But when we look at the relationship with new building, given all that demand, then of course a lot of those international migrants, whether they're students or permanents, will be heading to Sydney to live. Now, look at this is the latest building approval data that we have, Graeme, for January. And you can see there that total homes approved over January, and this is lower than in Sydney than in Brisbane and Melbourne. And they're half that of what Melbourne approved, houses and units. And, Sydney's about 30% higher. Brisbane's about 30% higher.
We'd have to make the assumption that a lot of these are home upsizers or first home buyers or downs. Some of these people are owner-occupied residents as well, not just investors.
Well, look, the problem with the building approvals being so low in Sydney, Graeme, is that Sydney's Australia's biggest city, by the length of the strait. And we're not even building at the same rate as Brisbane, which is a much smaller, in terms of the number of homes, a much smaller capital city. So Brisbane's up and running. But look at what I think is very interesting is the unit numbers for Sydney. Now, these can be volatile from month to month, so we'll wait as the year progresses. But this trend has been evident for most of the past year, Graeme, that we've seen the number of units approved in Sydney for building significantly lower than Melbourne and also now lower than Brisbane. So Sydney, the home of units, Sydney has the highest proportion of units versus houses by, a long way of any of the capital city markets, and yet they're not building anywhere near as many new units as smaller capitals such as Melbourne and Brisbane, particularly Brisbane. This is quite remarkable. We've always seen Sydney as being the leader in terms of approvals or development for units, but not anymore, Graeme. And of course, we know, if you want to get a standalone house in Sydney, a new one anyway, you got to head down towards Goulburn. It's the outer suburbs are really now, part of the rural community in Sydney because it's spread so far because the geographical constraints are significant in Sydney. It's not like Melbourne and Sydney where you can continue to spread across flatland. So apartment living, just in terms of the proximity to the CBD and established infrastructure, is in high demand. And that's why we're seeing unit prices catching up, and certainly unit rents catching up with house prices and house rents, because demand is higher. And yet the latest data shows us that Sydney is continuing to underbuild, not just in relation to where it was a couple of years ago, but it's underbuilding clearly when we compare it with the smaller capital city markets that are actually also underbuilding, Graeme. So, compared to their longer term trends. So it's not good news.
It's not good news. You got people, the Central Coast and Wollongong are almost extensions of Sydney now. People are commuting from, particularly and its median price gone crazy. We might even look at that in the next couple of weeks. But it's very interesting. Sydney's almost put a ring fence around itself and gone, no, shut the gates and no more development, or it's just not feasible for builders and developers in the current market and the costs.
Well, that's the point, Graeme, that even with these low numbers of building approvals, the question is how many of these will actually become jobs because of the high cost of building. Those that have got these building permits may not be able to get the finance to commence the jobs because of the profit issues that high building costs make it, don't make these jobs feasible to commence. So even though these numbers are, confronting in terms of their volumes, we've got to understand that these are probably overstating the actual activity that's happening. And there's really nothing that can be done about this. I mean, I'm just surprised we haven't seen more of a moderation in building costs, but there is no sign that building costs are easing. So it's, you're in a corner here, Graeme. It's tough enough to get a building approval as it is, with all those barriers you got to jump. And now, if you get your building approval, you got to figure out how to make money from it because costs are so high. And here we are, month after month talking about a rental crisis and, being confronted with a flood of migrants to come into this country.
And if we look at that, what are we, year to date, Jan, right? Jan, Feb, nearly March. I mean, that's not what's that Emmetop? 4, 8, 12, 400 and something a month maybe for the last 3 months. That's nowhere near what we need.
Well, that's right, Graeme. And as I said, it just reinforces.
I was just looking at Brizzy as an example. Melbourne, we're screwed across the board.
And you can't change, Graeme. This can't be changed. This is the point. We're getting hit from both ends. Supply, we've got we've got falling supply from a low level, and we've got burgeoning demand. And we know those rental numbers that come out, and there's been predictions I've noticed, which I find problematic, that the rental market will start to ease. I don't know how that's going to happen unless people just decide to live with mum and dad for a lot longer or decide to share a house or a unit,
Well, now, even then, Doc, it's still ultra competitive and we still don't have enough dwellings. So it's how's it going to subside in cost? It's not. And
that only works for those that are here already, mate. It's not talk about the ones that are getting off the boat or the plane, to come and live here, right? At the end, they're not worrying about, having to consolidate their family size or their, the size of their community because they're just here ready to rock and roll, Got into Australia and let's get a house. We'll rent it maybe first and then purchase one. And they only come in if they have the financial, positives to be able to support themselves with housing, So there's the only thing that will stop rents rising, in my opinion, is the capacity to pay the rent. And the only thing that will stop that is how much of a wage rise you get, right? Yep. That's the only thing that will stop it because people, have got to eat and they've got to find other ways generally to live other than just paying their rental costs. That's the only barrier to higher rents is how much your wages are going up. And we're seeing the highest wage increases in a decade at the moment, but it's still not enough to catch up with rent. So this is a conundrum that, we're be interesting to see how it all works out over the year. But I think we're not going to see any relief for tenants anytime soon, really, Graeme, if ever. I think this is the problem. So we've got a special today, Graeme, for everyone. And what we're going to do now is have a mid-month housing market report. Are you excited?
Very.
Because we are in the middle of the month, right? We are, can you believe, in the middle of March now to the day. So let's have a look at just a little preliminary snapshot of how our housing markets have performed over the first half of March. Are you excited?
Oh, this can't be true. Home prices okay. Let's have a look.
Up again, Graeme. We saw for the first time since way back in March last year, we saw house prices increase nationally over February. So that was the first rise in house prices since April last year, March to April last year.
And that's 2 consecutive months in a row, Doc.
Well, as we're halfway through the month, we can see how we're travelling to this point of time. Now, we've still got 2 weeks to go. But having said all that, the trend remains higher and that prices have continued to rise over the first half of March. This is the national house price, is still rising. So at this stage anyway, it doesn't look like February was a oncer, that it was just going to be, it was just one of those things and that we'd see prices falling again. It looks like a consolidation of the upward trend in the cycle, Graeme, because national house prices have increased again over the first half of March or continuing to increase. So I guess we wait for the end of the month to get our final monthly data, but certainly the early data is again looking positive. And we know, as we always say, that national house price is basically about the Melbourne and Sydney markets because it's a weighted average, and that means it focuses on the bigger housing markets such as Melbourne and Sydney. So this is really telling us that Melbourne and Sydney are doing okay, and we'll have a look at that in a sec. But we've spoken about the unit market, haven't we, Graeme? And again, similar to houses, we've seen the national unit price continues to increase up
That's
over
the third month in a row, Doc?
No, it's the second month in a row. Again, similar to houses. So it's a rolling average, a rolling quarter there from February quarter to March quarter, which means we're taking a lot of observations, which gives it a nice, secure basis for its measurement. And again, up, Graeme, same as houses, units increase over the quarter. So let's have a look at how the capitals have gone. And we're going to look at all the capital cities here, so even the little ones where it can tend to be a bit more volatile. And, hey, look at Sydney, Graeme, up by 1.7% over the month of March so far, up by 1.7%. So remembering that it was up by 1.4% over February, actually the rate of growth is increasing in the Sydney market. Now, as I said, this is to the middle of the month. We've still got a month. We've still got a couple of weeks to go. So let's see how we hang on. But no doubt that the momentum is continuing in the Sydney market. And have a look at Melbourne. Melbourne's finally above the line, Graeme. Prices up by just 0.1%. But again, this is the first. If it holds up, and we've got 2 weeks to go, if this holds up, this will be the first price increase in Melbourne, monthly price increase since March last year. So
hold on to your hats, everyone, because Doc's telling you, if you were waiting for the bottom and you're one of those gurus who times the market instead of having time in the market, you're at the bottom or you've just missed the bottom.
Well, I think Sydney's showing us that, Graeme. This is 2 months in a row for Sydney. These are good results. They're not just marginally above the line. These are better than 1% for both months. Now, as I said, the disclaimer is this is just the mid-month report. So this is just giving us a bit of an indication. Things can change, but certainly the prospects remain quite positive. We even saw the Canberra market pick up over the month, which is the first time they've been up for a while, and Perth continues to strengthen. But even the other markets, Graeme, have just shown, if they're fallen, they're just down quite marginally, with the worst performance there, the Hobart market down by just 0.8% over that March quarter to the middle of the month. So some pretty, I think, encouraging numbers there, Graeme. And when we look at units, again, there's much more growth in units across the board than, and I'm talking about more capitals have recorded increases in unit prices compared to the number that recorded increase in house prices over the quarter to March so far. Sydney up again, 0.7% for units. Melbourne flat. That's the best result for Melbourne again for some time. Brisbane continues to grow up by 0.5%. Adelaide surged, but it's a small market in Adelaide, Graeme, so we can get some volatile results in that Adelaide unit market, but nonetheless positive. Similarly, Hobart down 7.8%, but once again, there's only a handful of units in Hobart, so the mix of property prices can have a big influence on the actual data. But I think again we're looking at a continuation of Sydney results, second month in a row, and Melbourne looking a lot better, and Brisbane continuing to rise in terms of its unit prices. So that's our mid-month report, Graeme. What do you think about that?
Well, I'm pretty excited. Just quietly out loud, Doc, I'm pretty excited.
Well, we'll see what happens at the end of the month, but something to stay tuned for, all right?
Absolutely.
Our real forward indicator, as we do every week, is look at those weekend auction markets. We've predicted this, Graeme. We've had strong results in our auction markets, particularly Melbourne and particularly Sydney, and following up with Melbourne recently, which has again proved a really reliable forward indicator of what's happening in our housing markets generally. Now, last weekend was a holiday weekend in Melbourne. It's interesting that Melbourne, this was Labor Day in Melbourne, which is their sort of Moomba festival, as they call it there. and it was a quiet weekend, as typically over a long weekend in Melbourne. So I call it distracted. But it's interesting that weaker Melbourne market through holidays tends to follow the other capitals, even though they don't have the same holiday as Melbourne for Labor Day. They have theirs at different times. Tends to follow that same sort of a weaker market environment. Now, I don't know what that is, but it's certainly an interesting common, I guess, event. But it was a distracted weekend in Melbourne. And we know when we look at those relationships, we show this every week, that you can trust auction clearance rates to tell you what prices are doing. You can see that clear relationship between prices and clearance rates in Melbourne and Sydney. So these are the results last weekend. Sydney down a little bit of a tick. It was actually its worst result for the year, Graeme, at 67.7%. Now, can you believe we're saying, oh, gee, that's not a good result, 67.7%, which is just a tip under 70%. Sydney's had 70% basically every weekend this year, 70% plus, but it wasn't far away from really where it was the weekend before. Auction numbers were down in Sydney as well, down by around about 100. We're going to have the pre-Easter Super Saturday in a fortnight, Graeme. I think a lot of sellers have booked their auctions in for that particular weekend.
Yeah.
So numbers will probably be a bit softer over the next couple of weekends in anticipation of that big Super Saturday prior to Easter. Melbourne, of course, as I mentioned, a holiday mode, just 276 auctions in Melbourne, which was well below the previous weekend. Clearance rate, again, just the high 60s, not too far away from where it was the previous weekend, but it was a holiday weekend. Not a lot of higher priced inner suburban properties went under the hammer. It was mainly outer suburban properties is what we see on those holiday weekends, but still a 68% clearance rate. Brizzy, just about the same as it was the weekend before. Brisbane's actually picked up a little bit recently, Graeme, with its clearance rates. Numbers were down in Brisbane. As I said, it's interesting that numbers were down everywhere, even though it was only Melbourne with the holiday. So I don't know what's happening there. But, Brisbane, similar result to the previous weekend, fewer auctions. Adelaide, again, similar result to the previous weekend with fewer auctions. And Canberra down a little bit, I guess, down by 5% with a big decline in the number of auctions. So, as I said, a distracted weekend, Graeme. Perhaps we'll look to this coming weekend when the markets are back up in full swing, just to see, how we return from that sort of holiday environment. So when we look at our monthly results, you can see Sydney so far this month down a little bit on February, but still tracking at the highest level since March last year, Graeme. So that tells you all. Mm-hmm. And hey, didn't we just say that Sydney house prices are now rising for the first time since, you guessed it, March last year? So reinforcing that measure. So everybody out there, take note of those auction clearance rates, because they'll tell you where prices are headed. Melbourne, it's averaging 70.1%. Good result. Again, the highest since March, April last year in Melbourne. Brisbane's picked up, Graeme, so we need to keep a bit of an eye on Brisbane. Not as strong as auction market as Sydney and Melbourne, but still can give us some important insights. And it's tracking at its highest levels since the same time last year. Adelaide down a little bit on its peaks, but it's been a bit up and down, but still, very good results for sellers in Adelaide, as it always does in terms of the auction market. And Canberra holding in the high 50s at the moment. Interesting to see if Canberra picks up on some of that positive energy coming out of Sydney at the moment, Graeme. Who would have believed Sydney back up and running 2 months in a row, maybe, of house price increases? Where are all those doomsayers, mate? Where have they gone?
Well, but they're definitely not on your LinkedIn getting the data, because they wouldn't be pitching such verbal diarrhea and being such a doomsdayer. But for those of you tuning in,
if you want to get the latest results, you get them on my LinkedIn channel. And
they're
soon to be put
not
up
on there.
Yeah, that's right. So keep a lookout for that. So we've had an interesting week. We always say this, don't we, Graeme, in the housing market? Certainly the big picture in the economy is we're watching the US banking sector, and we will watch what the Fed does with its interest rates next week in the US. It does have some implications for Australia. maybe if they put them on hold, our Reserve Bank governor might decide to do the same thing. There was some speculation in the latest commentary from the governor regarding interest rates that they may think about putting rates on hold just to see how things are going. But there's no doubt that the nature of inflation, is still high, and economies are still very, very strong. And I'm not sure how the Reserve Bank governor is going to, report or reflect on Sydney house prices rising again. Now, the point to this, Graeme, is when we talk about house prices, let's remember that Sydney has now recorded 2 months in a row of house prices, given those mid-month results. Melbourne looks like it's finally back in terms of being in the black, but both of those markets are still 6 and 7% down on where they were at the same time last year. So, I think what we're seeing, and we saw this in 2019, Graeme, after a similar weaker period in the market, that buyers start to move into the market because they sort of start thinking, hey, this isn't a bad time to buy because prices are lower than where they were a year ago. And I think we're seeing some of that sort of energy, people saying, hey, that's a pretty good price. I've got a great job. People are queuing up to want me to work for them. I got a big pay rise. What am I doing with my life? I want to get out there and get that nice house, or unit, which is lower still in price than where it was a year ago, but it's rising. So I don't want to think about, hey, maybe I'm going to miss out, just like you said, Graeme.
And we're seeing a lot of activity, Doc, people that are worried about the fixed rate cliff coming from their 2s and early 2% and 3s going, hey, can you refinance this now? I've been listening to your podcast and realised that each rate rise means I can borrow less. So if I don't break now and refinance now and buy, I might not be able to in another couple of rate rises.
That's right.
So I think for those of you tuning in, well done. Consumers are listening and you are starting to make some informed financial decisions. So well done to everyone tuning in.
And I do think that opportunity perceptions, value perceptions are an important part of the market dynamic, Graeme, particularly expensive markets such as Sydney, where, it's like, well, hey, I'm not going to wait. Its prices are still lower than where they were a year ago. And I think that's starting to create its own momentum. And then you get the fear of missing out sort of energy, which brings buyers out that have been sitting on their hands for the past year, right?
Absolutely.
And if this really, the markets have been reviving since September last year, where prices, although they were falling, weren't falling at the same rate. This has been a clear trend. Month by month, we've seen the rate of decline in house prices in Sydney and Melbourne easing. So it was getting a little bit less month by month. And finally, in a very orderly trend, actually, Graeme, we've seen prices now rising again. And we're yet really to see all the drive coming from migrants, that will only sort of support that. And maybe all these issues regarding the banking sector, not that, as I said, they have a lot of relevance to Australia, but, a lot of that risky investment in those startups, in the tech sector, people will start to, refocus again on, the old bricks and mortar investment, going forward, particularly in a rental market where we're seeing rents increasing by 10, 20, even 30% a year. And that's what we've seen in Sydney and Melbourne, with unit rents up 30% over the past year. Now, coming from a low base, of course, we know that. But certainly have caught up with what was a weaker period in those unit markets in Melbourne and Sydney, and now they're flying, because people can't afford to rent a house.
Absolutely, Doc. So it's only midway through the month, everyone, but stay tuned for the end of the month and for next week. And Doc and I will lay it bare, and we'll cut through the crap.
Yeah, and we've got a lot of data coming through, Graeme. We've actually got population data as well that'll be released over the next week. So we'll be able to see how population growth is going, which is important, particularly the migration numbers. We have the unemployment rate. Will it still look like easing a little bit as it did over January? Well, that'll be interesting to see whether that holds up. And, of course, internationally, we have the decision from the US in terms of its interest rates, what it will do with its interest rates, which has become a very challenging decision given what's happened in the banking sector. And, of course, we have our weekend auction markets back in town after the long weekend holiday in Melbourne last weekend. Lots to talk about.
Looking forward to it, Doc, and everyone stay tuned, and we'll see you next week.
Thanks, mate.
Thanks, Doc.